Welcome investors to Fiscal Voyage. My name is Felix, and in this video we're going to cover a stock that has a high dividend yield and has potential for 22 plus annual rate of return for the next 3 years. And currently the company has a dividend yield of 6.86%, so that's great income for you dividend growth investors out there. But before we get started, if you're new to the channel, make sure to hit that subscribe button for more videos and stock analysis on different investing ideas and helping you to become a better investor. So make sure to hit that subscribe button. Also make sure to check out my ebook that I have, which is called The 5 Steps to Finding the Best Dividend Growth Stock. This ebook helps you very easily with 5 simple steps to find the best dividend growth stocks for you. So let's get started. Hey, the high yielding stock that's a buy is at&t, ticker symbol T. Sure, you guys heard of this company or maybe even own shares of this company. It's a very well-known dividend growth stock. The company, if you don't know, is a multinational conglomerate holding company, is the world's largest telecommunication company, the largest provider of mobile telephone services and fixed telephone services in the United States through at&t Communications. And since June 14, 2018, it's also the parent company of mass media conglomerate Warner Media, making it the world's largest media and entertainment company in terms of revenue. And as of 2018, at&t was ranked 9th on the Fortune 500 rankings of United States' largest corporation by total revenue. All right, let's look at the fundamentals. From 2010 to 2019, the company grew revenue at a modest rate of 4.3%. Net income, however, had a compound annual growth rate of negative 3.9%. This has a lot to do with the purchasing of the Time Warner. The company has a good investment grade credit rating of BBB, so the likelihood of bankruptcy is very nil, less than 5%. Operating income in this 10-year period grew at 4.6%, and overall earnings grew at 5.1%. And the 5-year earnings growth average is much better at 7.13%. Net income has been turning around with a 5-year compounded annual growth rate of 1%, and revenue slightly higher than the 10-year average at 5.4%. So the company is making progress in increasing revenue. Net income again is positive, and earnings is higher than the 10-year average, so this is all positive signs here. And we continue with the fundamentals. For 2019, the company had adjusted earnings of $3.57. Net margin came in at 7.7% for 2019, which however was lower than 2018, where they had net margin of 11.3%. That's a little concerning. I like net margin increasing, where this is compressing, but for the first quarter they had a slightly higher net margin than the 7.7, so that's a positive sign there. Return on equity has been averaging for the past 5 years at 12.4%, and this is what makes this company very attractive. It is the dividend yield, 6.86%. However, with this high dividend yield, you do get a low dividend growth rate, where the 5-year dividend growth rate was only 2.1%, and the most recent increase was 2% in December of 2019. So the next dividend increase will be most likely December of this year. But even though the company has a high dividend yield, the payout ratio is very safe at 64.7% for the adjusted earnings, based on the adjusted earnings. So the dividend is very safe in that aspect, and they've been growing dividends for 36 consecutive years, so I don't see them cutting the dividends anytime soon. So it's very safe dividend with a high yield. So this is more towards for income investors looking for most income. This tends to be investors that are in the older age bracket, but I do own shares, and I'll talk about that later in the video. But the current yield and the 5-year growth rate gives us a charter rule of 8.96, so it's lower than our recommended or criteria of 11, 12 and higher. But I'm okay with that because of the current yield. If you're looking for a nice income stock, this is it right here. And the 5-year dividend yield average at 5.55%. The current yield is 6.86%. So this is a good indicator that the company may be undervalued, and we'll see that in a few slides from here. Let's look at the balance sheet, because a lot of people complain about AT&T debt, which is very reasonable. Debt to cap at 45%. The current ratio is at 0.76. You like to see this ratio at 1.5 or higher. So basically, the company has more liability than assets. However, the debt to equity is very respectable at 1.05. Of course, the higher the better, but the debt to equity ratio is modest here. And the interest coverage at 3.33 means that the company is able to cover their interest. So that's good there. So the interest coverage is 3 times. So that's good. The price to book ratio at 1.21, which is much lower than the 5-year average of 1.67. So if we look at the future outlook, 2020, analysts are expect earnings of $3.26. 2021, $3.30, and CFRA has a 3-year projected earnings growth of 1.5%. Using the dividend drill return model, I get a total projected return of 11.1%. This is great because this company has a very high yield, and most often than not, when a company has a high yield, their annual return is much lower because they're using a lot of their earnings for the dividends instead of growing the revenue and growing the company. But because the valuation is very attractive, and we'll see that in a few slides, it gives this a total return of 11.1%. So that's very good there. Forward PE is at 9.2. Currently, the current PE is 8.7, and that means the forward PE means that the 2020 earnings are expected to be lower than 2019, and we'll see that in the fast graph. But the forward PE is much lower than the 5-year PE average of 16.8. So the company tends to average with a normal PE around 13 to 16. So that's a good indicator that it may be undervalued based on PE. So if we look at the fast graph here, the black line is the monthly closing price, and the blue line is the normal PE of 13, and the orange is the earnings of 15 multiple. And you can see here the black line is under both the blue and orange, so there's a good indicator based on the fast graph that it may be undervalued. And if we project out to 2022 earnings of estimated $3.44, we may have a projected annual rate of return of 22.2%. That's very attractive there. With the current dividend yield, the safe dividend yield, this right here gives me a confidence that the company may return 22.2%. Analysts has been very accurate in estimating the earnings, so I'm very confident in that. And as you can see, in the past few years, from 2013 to 2017, the company has been between a PE of 13 and 15. So that's why the 5-year average is much higher than the current PE ratio. So that's an indicator that it may be on the value where prior years investors value the company between 13 and 15. And as I said, at current PE, we have an 8.8 PE. So that's an indicator that may be undervalued. And if you look at the blended adjusted earnings yield of 11.3, that's very, very attractive. A blended adjusted earnings yield of 6.5 and higher is attractive, and we're getting here at 11.3. So this is a good opportunity, I think, for owning AT&T. And like I said, I own shares, and I'll talk more about that later. And if we look at the fair value price, CFRA has a fair price of $34.35, Morningstar at $37. Fast Graph at $42.61, as we just saw, and Yahoo at $33.72, and my dividend discount model analysis at $30.31. For my dividend discount model analysis, I use a 2% dividend growth for the next 3 years and 2% after that with a discount rate of 9%. Normally I use a discount rate of 10%, but because the company has a high dividend yield currently, I lowered the discount rate from 10 to 9%. So that gives me $30.31. Averaging out the 5, we get a fair price of $35.60, and currently the company goes for $30.07. And that means it's undervalued by 18.1%. That is meets my criteria of 10% or more undervaluation. So this is great. And that's why the current recommendation for AT&T stock is a buy. So as you just saw, I have a buy recommendation for AT&T. I currently own shares of this company. It's one of my biggest positions currently. And for the year, I'm expected to make over $600 in total dividends. So some of the things that I like is that high dividend yield. However, that growth rate is very low at 2%, but that high dividend yield makes up for it. And the biggest thing right now going for the company is its valuation with that dividend yield. So that makes it very attractive. With over 11%, using my dividend yield return model, we get a projected annual rate of return of 11% or higher. And the past 5 years has been much better than the past 10 years. So it looks like the company is growing revenues as well as earnings at a better rate. Again, one thing to consider, however, is the balance sheet of the company with the current ratio of 0.76. That's much lower than the minimum requirement, more or less, of 1.5. But the company does have a nice interest coverage of 3.33, so that means it's able to cover its interest payments at least. So being able to cover that means you'll be able to make your payments. So that's a good thing. And that valuation is very attractive, where the current PE is much lower than the 5-year average. And the 18% undervaluation is very attractive at current prices, so that's all plus, and that's why I have a buy recommendation. But again, just because it has a buy recommendation doesn't mean you go out there and actually buy it. Make sure you do your own homework, research the company, read the annual reports, look for the story. Is it projected to go even higher next year and the following year, for the next 5-10 years? I think so, but make sure you do your own homework as well. So again, thank you for watching, and if you're new to the channel, make sure to hit that subscribe button for more videos like this. And again, thank you for watching, and I'll see you in tomorrow's video.